The United States dollar is not just America's currency. It is the foundation upon which the entire global financial system is built. And right now, that foundation is showing cracks that almost nobody is explaining to ordinary Americans who depend on the dollar for their savings, their purchasing power, and their financial security. The dollar just fell for the second consecutive trading session. The dollar index slipped to around 97.5 as uncertainty over U.S. tariffs continues to dampen confidence in the world's reserve currency. And if you do not understand why the phrase reserve currency matters, if you do not understand what those two words mean for your daily life, you are missing the single most important factor determining whether your money holds its value or slowly evaporates over the coming years. Let me show you exactly what is at stake because the numbers are staggering and the implications are immediate. The US dollar is used in 89% of all foreign exchange transactions on Earth. That is not a typo, 89%. Every time a Japanese company buys oil from Saudi Arabia, the transaction settles in dollars. Every time a German manufacturer pays a Chinese supplier, dollars are involved somewhere in the chain. Every time an Indian bank lends to a Brazilian corporation, the loan is often denominated in dollars. The entire machinery of global commerce runs on the dollar as its operating system. According to the Bank for International Settlements Triennial Central Bank Survey, this 89% figure represents the dollar's share of one side of foreign exchange transactions in 2025. Because there are two currencies in every transaction, the percentages add up to more than 100%. The euro, in second place, appears in only 29% of transactions. The dollar is more than 3 times as dominant as its closest competitor. But the foreign exchange transaction share is just one dimension of dollar dominance. The more important dimension, the one that determines whether the global financial system trusts the United States, is the reserve currency share. As of the third quarter of 2025, according to the International Monetary Fund's currency composition of official foreign exchange reserves dataset, dollar-denominated securities make up approximately 57% of global foreign exchange reserves. That represents $7.4 trillion in U.S. Treasuries and investment-grade corporate bonds sitting in the vaults of foreign central banks and governments. The euro, in second place, makes up approximately 20% of reserves. The Japanese yen accounts for about 6%, the British pound about 5%. The Canadian dollar and Chinese renminbi each account for about 3% and 2% respectively. These reserves are not trivial accounting entries. They are the rainy day funds of nations. Governments hold them for exchange rate management to defend their currencies against speculative attack. They hold them as insurance against sudden loss of ability to pay for imports if capital inflows stop. They hold them as protection against wars, natural disasters, and economic contingencies that cannot be predicted. When a country faces a crisis, it draws down its reserves, and those reserves are overwhelmingly denominated in dollars. The 5 largest holders of foreign exchange reserves in 2024 were China, Japan, Switzerland, India, and Russia. China alone held 26% of all foreign exchange reserves globally. Japan followed with 9%. These are the countries whose faith in the dollar determines whether the system holds together or falls apart. Now let me show you why this matters for you specifically. Because the abstract concept of reserve currency status becomes very concrete when it affects your daily financial life. When governments and central banks hold large quantities of dollar assets, they create demand for those assets that would not otherwise exist. That demand pushes up the prices of treasury bonds. Higher bond prices mean lower yields. Lower yields mean lower interest rates throughout the American economy. Your mortgage rate is lower because foreign central banks are buying treasury bonds. Your credit card rate is lower. Your car loan rate is lower. The borrowing costs for American businesses are lower, which means they can hire more workers and pay higher wages. The reserve currency status is not an honor or a privilege that exists only on paper. It is a subsidy that flows through the entire American economy. It reduces borrowing costs for the government, allowing larger deficits than would otherwise be possible. It reduces borrowing costs for corporations, allowing more investment than would otherwise be profitable. It reduces borrowing costs for households, making homes more affordable, and consumer spending more accessible. And here is the critical point. That subsidy exists only as long as the rest of the world believes in the dollar. The moment confidence wavers, the moment foreign central banks start diversifying away from dollar assets, the moment the 57% share starts declining meaningfully, the subsidy disappears. Interest rates rise, borrowing costs spike. The entire economic structure that Americans have built on cheap credit gets squeezed. This is not theoretical. This is exactly what markets are warning about right now. The dollar is falling. For the second consecutive session, the dollar index slipped to around 97.5. And the catalyst is something that should alarm every American who depends on the stability of the global financial system. Tariff uncertainty. Let me show you what the tariff chaos is doing to confidence in the dollar, because the connection is direct and immediate. On Wednesday, U.S. Trade Representative Jamieson Greer announced that the U.S. tariff rate for certain countries could rise to 15% or higher from the recently implemented 10%. He provided no specifics. He did not name any trading partners. He did not explain which goods would be affected. He simply announced that rates would go higher for some unnamed countries in some undefined way at some unspecified time. This is the kind of policy uncertainty that makes foreign investors question whether they want to hold dollar assets. If you are a central bank in Asia or Europe or the Middle East, you are watching American trade policy change by executive order get struck down by the Supreme Court and get replaced with new tariffs within 48 hours. You are watching a system where the rules change weekly, where commitments to trading partners are abandoned without warning, where legal frameworks are circumvented the moment they become inconvenient. President Trump's State of the Union address provided no clarity. Analysts from Westpac wrote that the address focused on the economy, but provided little to no information on new policy initiatives. The U.S. Trade Representative offered no details regarding how the higher tariff would be applied in situations where it breaches U.S. trade deals. In other words, even after the president's most important speech of the year, nobody knows what the tariff policy actually is. The Supreme Court struck down Trump's emergency tariffs on February 20th. He has signaled no intention to alter his approach. New tariffs are being imposed under different legal authority. The cycle of imposition, legal challenge, and reimposition continues with no end in sight, and every cycle erodes confidence in the stability and predictability of American economic policy. This matters for the dollar's reserve status because reserve currencies must be stable. The entire point of holding foreign exchange reserves is to have assets whose value you can rely on during a crisis. If the policy environment in the United States is chaotic, if the legal frameworks keep changing, if the rules of international trade are unpredictable, then dollar assets become less reliable as insurance. And when dollar assets become less reliable, central banks start looking for alternatives. Now let me show you the efficient market hypothesis explanation, because it reveals something important about how quickly confidence can collapse. Eugene Fama won a Nobel Prize in economics in 2013 for work on the efficient market hypothesis. One implication of this theory is that financial markets are forward-looking. If market participants expect something to happen in the future, they act on that expectation immediately rather than waiting for the event to occur. Applied to the dollar, this means that if markets or market participants such as governments or central banks come to believe that the U.S. will engage in bad economic policy that endangers the value of the dollar, they might seek to rebalance their portfolios as soon as they can. This immediate rebalancing would drive down the value of the dollar right now, not later when the bad policy materializes. In other words, the sell-off does not wait. If you expect the dollar to fall a lot next week, you sell today. And if enough people expect the same thing and sell today, the dollar falls today, not next week. The expectation becomes self-fulfilling. This is why tariff uncertainty is so dangerous for the dollar right now. Every chaotic announcement, every contradictory statement, every Supreme Court ruling followed by executive order defiance, all of it feeds into market expectations about future policy. If those expectations turn negative enough, if enough investors conclude that American economic policy is becoming unpredictable or damaging, the selling happens immediately. The dollar does not wait for the damage to materialize. It prices in the damage as soon as expectations shift. The dollar falling for 2 consecutive sessions is not random noise. It is markets processing information about tariff uncertainty and adjusting expectations accordingly. The 97.5 level on the dollar index reflects a market that is less confident in American economic policy than it was a week ago, and if that confidence continues to erode, the dollar continues to fall. Now let me show you the international competition, because the dollar's dominance is not guaranteed, and competitors are emerging. The Chinese yuan just hit its strongest level against the dollar in 3 years. In offshore trade, the dollar was last flat at 6.854 yuan. That is the most favorable exchange rate for the Chinese currency since 2023. While the yuan is not yet a serious competitor to the dollar as a reserve currency, accounting for only about 2% of global reserves, the direction of travel matters. China has been systematically building the infrastructure for yuan internationalization, belt and road lending in yuan, currency swap agreements with dozens of countries, digital yuan development, alternative payment systems that bypass dollar-denominated networks. All of it designed to reduce global dependence on the dollar over time. At the same time, the Bank of Japan is signaling possible near-term rate hikes. Bank of Japan Governor Kazuo Ueda said the central bank will scrutinize data at its March and April meetings in deciding whether to raise interest rates. This is significant because Japanese rate hikes reduce the interest rate differential between Japan and the United States. When Japanese bonds pay more relative to American bonds, the incentive to hold dollar assets diminishes. The yen strengthened 0.2% against the dollar to 156.045 on Thursday, clawing back some ground after hitting its weakest levels in 2 weeks. The dynamics between the yen and dollar are shifting as Japan normalizes its monetary policy after decades of near-zero rates. If the yen continues strengthening, if Japanese investors bring capital home to capture higher domestic yields, that represents selling of dollar assets that weakens the greenback. Capital economics analysts wrote that further efforts from the Takaichi government to influence the BOJ threatens another round of turmoil in Japan's bond and currency markets. But they think the underlying fundamentals point towards continued stabilization in the JGB market and a rebound in the yen. A rebounding yen means a weaker dollar, and a weaker dollar in the face of tariff uncertainty and policy chaos reinforces the narrative that the dollar's dominance is eroding. Now let me show you the historical context, because understanding how the dollar became the reserve currency helps you understand what could make it lose that status. Before World War II, countries generally had limited foreign exchange reserves. Most developed countries tried to return to the gold standard after World War I, but then abandoned it during the Great Depression of the 1930s. During that period, governments typically held a combination of gold and British pounds to serve the role of foreign exchange reserves. The pound was the dominant reserve currency before the dollar. After WII, the United States was the dominant global economy, producing about 40% of world output in 1960, according to the World Bank. A combination of factors caused countries to choose to hold dollar assets as foreign exchange reserves. The most important was probably the Bretton Woods system of fixed exchange rates, created in 1944. Under Bretton Woods, countries fixed their currencies to the US dollar, promising to buy and sell foreign exchange to maintain the fixed price. The US obligation was to fix the price of the dollar to gold at $35 per ounce. To defend their exchange rate pegs against potential speculative attack, foreign countries accumulated liquid US dollar assets as reserves. Some of these dollars entered foreign holdings from US aid, while others were obtained by exporting goods and services to the US. The Bretton Woods system collapsed in 1971 when the United States abandoned the gold peg. But the dollar's reserve currency status survived. Why? Because by then, the infrastructure of global finance was built around the dollar. The contracts were denominated in dollars. The payment systems ran on dollars. The accounting was done in dollars. The habits and institutions and networks all assumed dollar dominance. Changing the system would have been enormously costly, even if a superior alternative existed. This path dependence is what protects the dollar today. Even if another currency might theoretically be better suited to serve as the global reserve, the switching costs are astronomical. You would have to rewrite contracts, rebuild payment systems, retrain entire financial industries, and coordinate action among hundreds of governments and central banks simultaneously. The dollar's dominance is self-reinforcing because changing it is so difficult. But path dependence is not permanent. The British pound lost its reserve currency status to the dollar over a period of decades. The transition was not sudden, it was gradual. The pound's share of reserves declined while the dollar's share rose. Eventually, a tipping point was reached and the dollar became clearly dominant. The same gradual erosion could happen to the dollar if confidence continues to deteriorate. Now let me show you the Federal Reserve dimension, because monetary policy affects the dollar's attractiveness as a reserve asset. Financial markets continue to believe almost unanimously that U.S. interest rates are going nowhere at the Federal Reserve's next meeting. Fed funds futures are pricing an implied 98% probability that the central bank will keep rates on hold at its March 18th meeting. That is virtually certain. But holding rates steady while tariff chaos persists creates a difficult combination. High rates support the dollar by making dollar assets more attractive to yield-seeking investors. But policy uncertainty undermines the dollar by making those assets seem riskier. The two forces partially offset each other. If the Fed were to cut rates aggressively, the dollar would likely weaken further because the yield advantage of holding dollar assets would diminish. If the Fed were to raise rates, the dollar would likely strengthen, but at the cost of slowing the economy and potentially triggering a recession. The Fed is stuck in a position where any action has consequences that complicate the dollar's trajectory. Meanwhile, bond traders are betting on Fed rate cuts extending into 2027. SOFR spreads have inverted, indicating expectations of prolonged easing. Options trades worth $40 million are betting the Fed funds rate falls to 2% by year end. The market is pricing a scenario where the Fed cuts and keeps cutting for years. If that scenario materializes, the dollar weakens structurally. Lower rates mean less yield advantage. Less yield advantage means less incentive for foreign investors to hold dollar assets. The 57% reserve share would face downward pressure as central banks diversify into alternatives that offer better returns. Now let me show you what happens to the reserve share when the dollar declines, because there is a mechanical effect that people often overlook. Let me give you a simple example from the Federal Reserve's own analysis. Suppose a country has a foreign exchange reserve portfolio consisting of $1 billion and 1 billion euros. At an initial 1.1 exchange rate, that portfolio is worth $2 billion total, and US dollar assets make up 50% of the portfolio. Now suppose the dollar declines in value by 10% against the euro. The portfolio's dollar value is still $1 billion, but the value of the 1 billion euros has risen in dollar terms to $1.1 billion because each euro is now worth $1.1. The total value of the portfolio is now $2.1 billion, and the proportion of dollar assets is $1 billion divided by $2.1 billion, which equals 47.6%. Without anyone actively selling dollar assets, without any deliberate rebalancing, the dollar's share of the portfolio fell from 50% to 47.6% simply because the dollar weakened. Changes in the dollar's value mechanically affect the proportion of foreign exchange portfolios it makes up. This creates a feedback loop. If the dollar weakens, its share of reserves falls automatically through valuation effects. If central banks then notice their portfolios are underweight dollars and do not rebalance back toward dollars, the lower share becomes permanent. And if they use the opportunity to diversify further into euros or yen or gold, the share falls even more. The 57% reserve share is not static. It moves with exchange rates. It moves with deliberate portfolio decisions by central banks. And in an environment where the dollar is weakening and confidence is eroding, both mechanisms push in the same direction: lower share, less dominance, diminished reserve currency status. Now let me bring all of this down to what it means for your money, because the abstract percentages and institutional dynamics become very concrete when they affect your household finances. If the dollar's reserve currency status erodes, your borrowing costs rise. Foreign central banks buying treasury bonds keep interest rates lower than they would otherwise be. If they buy fewer treasuries, if they diversify into euros or yen or gold, there is less demand for American debt. Less demand means lower prices. Lower bond prices mean higher yields. Higher yields mean higher interest rates on your mortgage, your credit card, your car loan, your student debt, everything. If the dollar's reserve currency status erodes, your purchasing power declines. A weaker dollar means imports cost more. Everything from Asia, from Europe, from everywhere becomes more expensive when priced in a declining currency. Your grocery bill rises, your electronics cost more. Your vacation abroad is beyond reach. The standard of living that Americans have enjoyed because the dollar buys more than other currencies would diminish. If the dollar's reserve currency status erodes, the government's fiscal situation deteriorates. The United States runs massive deficits because it can borrow cheaply. Reserve currency status keeps borrowing costs low. If that status erodes, if yields rise, the interest payments on the national debt explode. Currently at around $1.4 trillion annually, those payments would grow toward $2 trillion or more if rates spike. The government would face impossible choices: cut spending dramatically, raise taxes dramatically, print money, and accept even higher inflation. None of those options are pleasant for ordinary Americans. If the dollar's reserve currency status erodes, alternative assets benefit. Gold, which has already rallied 60% in the past year, would likely rally further. Bitcoin, despite its recent losses, would attract capital fleeing the dollar. Real estate, commodities, anything that holds value independent of government policy becomes more attractive relative to dollar-denominated financial assets. The transition would not happen overnight. The British pound's decline took decades. But the direction of travel matters. If the 57% share becomes 50%, then 45%, then 40%, the cumulative effect on American economic life would be profound. The subsidy that has supported American consumption and borrowing for 80 years would gradually disappear. And here is what makes the current moment so dangerous. The tariff chaos, the Supreme Court battles, the policy uncertainty, all of it accelerates the erosion that might otherwise take decades. Every time a trading partner questions whether American commitments can be trusted, they edge closer to diversifying their reserves. Every time the legal framework changes overnight, they edge closer to alternatives. Every time the dollar weakens on uncertainty rather than fundamentals, they edge closer to rebalancing. The efficient market hypothesis says expectations get priced in immediately. If enough market participants conclude that the dollar's trajectory is negative, the selling happens now, not in 10 years, now. And that selling makes the trajectory more negative, which triggers more selling, in a feedback loop that can accelerate far faster than gradual historical transitions would suggest. The dollar index at 97.5, down for the second consecutive session, is not yet a crisis. But it is a warning. It is the market processing information about tariff uncertainty, about Supreme Court rulings being defied, about trade policy that changes weekly, and concluding that confidence in American economic governance is lower than it was. That lower confidence translates into a lower dollar. A lower dollar translates into higher import prices, higher inflation, higher borrowing costs. And if the process continues, if confidence continues eroding, the 57% reserve share that has subsidized American economic life for generations comes under direct threat. Let me show you what to watch for, because the next few months will determine whether this is a temporary blip or the beginning of something more serious. Watch the dollar index. If it continues falling, if it breaks below 97 and then 96, the market is telling you that confidence is declining. Technical support levels matter because they reflect institutional buying and selling decisions. Watch the yuan. If the Chinese currency continues strengthening past the 6.854 level, if it approaches 6.5 or lower against the dollar, China's alternative financial infrastructure becomes more attractive. The yuan's strength signals growing confidence in Chinese economic management relative to American chaos. Watch the reserve composition data. The IMF releases COFR data quarterly. If the 57% share starts declining, if the euro or yen or gold share starts rising, central banks are actively diversifying away from the dollar. That is the most direct signal that reserve currency status is eroding. Watch the Fed. If the Fed cuts rates while inflation remains elevated, it signals prioritization of political convenience over price stability. That is exactly the scenario ING warned could trigger a run on the dollar. Fed credibility is the cornerstone of dollar credibility. Watch the tariff announcements. If clarity emerges, if the chaos subsides, confidence might stabilize. But if the uncertainty continues, if rates keep changing, if trading partners keep being surprised, the erosion accelerates. I am not a financial advisor, and nothing I say should be taken as financial advice. But what I can tell you is that the dollar's reserve currency status is the single most important structural advantage the American economy possesses. It lowers your borrowing costs. It increases your purchasing power. It allows the government to run deficits that would bankrupt any other country. And right now, that status is under pressure from tariff chaos, policy uncertainty, and a legal framework that changes faster than anyone can track. The 89% transaction share, the 57% reserve share, the $7.4 trillion in foreign holdings of dollar assets. All of it depends on confidence. Confidence that the United States will maintain stable institutions, predictable policies, and reliable legal frameworks. Every piece of chaos, every Supreme Court battle, every tariff announcement without specifics chips away at that confidence. The dollar falling for 2 consecutive sessions is not yet a crisis, but crises do not announce themselves in advance. They build gradually through erosion of confidence, and then accelerate suddenly when a tipping point is reached. The question is not whether the dollar faces challenges. It obviously does. The question is whether those challenges remain manageable or whether they compound into something more serious. Subscribe to Market Acme right now and join our WhatsApp community for real-time updates, because the reserve currency dynamics I just explained are playing out in real time. Every tariff announcement affects confidence. Every Fed decision affects yields. Every move in the yuan affects competitive positioning. And all of it feeds into the 57% share that determines whether the dollar maintains its dominant status or begins a transition that has not happened since the British pound lost its position after World War II. I am Kenzo John. I am not a financial advisor. This is Market Acme, and I will keep showing you what the reserve currency data actually reveals, what the Forex transactions actually signal, and what the gap between American policy chaos and global confidence requirements actually means for your financial life. Because in an environment where 89% of global transactions run on the dollar, where 57% of reserves are held in dollar assets, and where confidence in American economic governance is being tested daily by tariff chaos and legal uncertainty, the stability of your savings depends on dynamics that most people never think about until it is too late. The dollar is falling, the yuan is strengthening, the yen is recovering, the gold is rallying, every alternative to the dollar is becoming more attractive relative to it. And the foundation of global finance, the reserve currency system that has subsidized American economic life since 1945, is showing cracks that get wider every time the next chaotic announcement hits. Join our WhatsApp community for updates because the reserve currency dynamics do not wait for you to understand them. They move markets, affect prices, and determine purchasing power, whether you are watching or not. The only difference is whether you understand what is happening and can position accordingly, or whether you remain oblivious until the consequences show up in your grocery bill, your mortgage statement, and your retirement account. 89% of transactions, 57% of reserves, $7.4 trillion in foreign holdings. These numbers are not abstract statistics. They are the architecture of your financial life, and that architecture is under stress.